Welcome to Tesla Daily News podcast on April 22nd, 2026. Today, we're focusing on the biggest, most stock-relevant Tesla developments, what to watch in Tesla's earnings, how autonomy and AI spending may change the valuation story, and a few key regulatory and competitive headlines that could move Tesla. Let's start with the main event. Story 1. Tesla earnings are tonight, and the market is set up for a big move. Here's the hook. Tesla is about to report first quarter results with investors laser-focused on one question. Is Tesla still an EV company, or is it successfully becoming an AI and robotics company? Context: Tesla's stock multiple still looks like a tech platform, not a car maker. That only works if the narrative around Robotaxi, full self-driving, and Optimus keeps progressing fast enough to justify big capital spending. Details. Going into earnings, we already know the quarter's operational snapshot. Tesla delivered 358,023 vehicles, up 6% year-over-year, but down 14% sequentially. Production was 408,386 vehicles. That production over-delivery gap is the widest in company history, which signals inventory build and demand uncertainty. On the financial side, the street's numbers cluster around roughly $22 billion to $22.7 billion of revenue and adjusted earnings per share around 0.33 to 0.39. Options markets are pricing a post-earnings swing on the order of high single digits to low double digits. Impact: if Tesla confirms demand softness, keeps cutting prices, or guides to higher inventory, you can see pressure on automotive gross margin and near-term sentiment. But if Tesla gives credible autonomy progress and a believable pathway to high-margin software revenue, that tends to overpower near-term delivery noise in this stock. Takeaway: tonight's call is less about the income statement and more about whether management can make the Robotaxi and AI story feel measurable instead of aspirational. Story 2. Capex is the bull-bear battleground, and it's getting big. Hook: Tesla's spending plan is ramping dramatically, and investors have to decide whether they're buying a cash machine or funding a moonshot. Context: Tesla's legacy advantage came from manufacturing scale and EV software integration. Now Tesla is trying to translate that advantage into AI compute, autonomy, and humanoid robotics. That transition can depress free cash flow before it pays off. Details. One earnings preview notes Tesla is projected to spend more than $20 billion this year, up from about $8.5 billion in 2025. The same preview suggests free cash flow could go negative temporarily. Separately, analysts are debating the cost of large future projects like new manufacturing capacity for AI and robotics. Impact: for Tesla, higher capex without near-term revenue visibility typically compresses the multiple. But if Tesla ties that capex to near-term milestones, like expanded supervised robotaxi operations, better unit economics on compute, and clear Optimus commercialization steps, it can actually support the valuation. Takeaway: investors should listen for specificity, spend categories, timing, and what concrete outputs that spending buys over the next 12 to 18 months. Story 3. Energy is the quiet stabilizer, and Q1 set a record. Hook: while the car side is choppy, Tesla Energy just posted a standout deployment number. Context: Tesla's energy storage business is increasingly important for investors because it can diversify revenue and potentially deliver different margin and cyclicality than the EV business. Details. Energy storage deployments hit a record 8.8 gigawatt-hours in the quarter. Impact: if Tesla continues to scale Megapack and grid storage profitably, it supports the thesis that Tesla isn't a single-product auto company. That matters a lot when auto margins are under pressure from price competition. Takeaway: watch for margin commentary and backlog indicators in energy. This segment can become a bigger part of the story if autos remain in a demand digestion phase. Story 4. Tesla just cleared a key China compliance step for generative AI in vehicles. Hook: Tesla registered its AI-driven voice assistant feature with China's cyberspace administrator in Shanghai. Context: China is Tesla's second-largest market and its most intense competitive battlefield. At the same time, China's regulatory environment for AI is evolving quickly, and filings and approvals can influence how fast Tesla can ship new software experiences. Details. The filing is part of a broader Shanghai process that included 158 AI-powered functions and applications that completed local filing. Reports also note Tesla has been trying to defend share in China, where full self-driving still has not been approved for delivery. Impact: this doesn't equal an autonomy approval, but it does show Tesla is engaging the regulatory framework for in-car AI features. If Tesla can improve the in-car experience with generative AI voice and local integrations, that helps competitiveness against Chinese EV makers that are racing to ship AI-heavy features. Takeaway: investors should treat this as incremental positive friction reduction in China, not a green light for full autonomy. Story 5. Competitive pressure is escalating fast. Batteries are the new arms race. Hook. CATL says it can charge a battery from 10% to 98% in about 6.5 minutes. Context. Even if the claim is under ideal conditions, charging speed is one of the most psychologically important EV adoption barriers. If Chinese battery leaders push charging times closer to gas station convenience, pricing power and brand differentiation across EVs shifts. Details. CATL's latest Xinjiang battery generation was presented with a claimed 10 to 80% charge time of about 3 minutes and 44 seconds, and 10 to 98% in 6 minutes and 27 seconds. CATL also highlighted its global leadership position with around 38% market share. Impact. If these capabilities move from lab claims to mass deployment, it raises the bar for Tesla and the rest of the industry. Tesla's response could come through supercharger tech, battery chemistry, pack architecture, or software-managed preconditioning, but investors should expect the market to price in tougher competition on the user experience side. Takeaway. The charging narrative is no longer just about station count. It's increasingly about chemistry, thermal management, and whether the ecosystem can actually deliver those peak rates reliably. Story 6. Tesla faces another reminder that software and safety perception move the stock. Hook. Tesla reached a settlement in a Florida wrongful death case tied to a dispute over a speed limiter. Context. Tesla's long-term valuation depends on trust in its software stack, especially as it pushes autonomy. Legal headlines can shape public perception, regulatory posture, and the risk discount investors apply. Details. The case involved a 2018 crash of a Model S, with court records indicating the driver was traveling around 116 miles per hour on a curve with a 25-mile-per-hour limit. Plaintiffs had argued Tesla was partly responsible, alleging a technician disabled speed-limiting software that had been set to cap speed at 85 miles per hour. Tesla denied wrongdoing and argued reckless driving caused the crash regardless. Impact. Financially, settlements are often manageable for Tesla, but the reputational and regulatory overhang matters. In the current market, anything that complicates Tesla's autonomy rollout narrative can influence analyst sentiment quickly. Takeaway. Tesla investors should separate headline risk from fundamental product trajectory, but don't ignore that safety perception affects the speed of autonomy adoption. Story 7. Regulatory hits in Europe show how expensive software decisions can get. Hook. Norway Supreme Court ordered Tesla to pay compensation over reduced charging speed after a software update. Context. Tesla's software-first approach is a competitive advantage, but it also creates legal exposure if updates materially change performance and consumers argue disclosure was inadequate. Details. Tesla was ordered to pay a total of roughly €523,000 to 115 plaintiffs, or about €4,545 per person. The case stems from a 2019 software update to Model S vehicles that Tesla said improved safety and battery longevity, but that also reduced charging speed. Impact. This is not a company-threatening number, but it reinforces a theme. As vehicles become software-defined, the legal and regulatory expectation for transparency rises. That affects how Tesla manages performance, degradation, and feature changes over time. Takeaway. Expect more scrutiny globally on how automakers communicate software-driven changes, especially those affecting range or charging. Let's wrap it up. Today's big themes were simple: earnings and guidance tonight, the capex versus milestones debate, and the rising pressure from China's battery and EV ecosystem. The stock implication is that Tesla's multiple will hinge less on quarter-to-quarter deliveries and more on whether autonomy, AI, and energy can show credible, repeatable progress. For tomorrow, watch the market reaction to Tesla's earnings call, especially any updates on Robotaxi timelines, full self-driving approvals, and how management frames the jump in capital spending. If you want this every trading day, subscribe to Tesla Daily News Podcast and follow us for the next episode with the post-earnings breakdown.